All right, welcome back. My next guest, he's a pseudo fan of the shutdown. He thinks that the longer it goes on, the more bullish he gets. Now, in fact, he says that the probability of the next two rate cuts gone up due to the shutdown. I get it. As the shutdown lingers, economic data will probably most likely soften, further emboldening the Fed to cut twice. Now, the short-term volatility is really not a liability, he says, but it's an opportunity. He also talks about Tesla. They report earnings this week. It'll be a big mover, he says, and he thinks Tesla is a name you want to buy on every dip. Elon Musk is the future of AI. No one is smarter than Elon. And if you're bullish on AI, then you must own everything Elon Musk and Tesla. After all, it's definitely more than a car company and trades like a tech stock, right? We like what he's got to say, so we're going to have him on to enlighten us some more. Please welcome to the show, Mr. Eddie Ghabour. And that rhymed, and I didn't really even mean it to rhyme. But anyway, let's go with that. Eddie, thanks for coming on. I agree with you.
Thank you.
About your sentiments about the shutdown and Tesla. But what are your thoughts on everything? Give us your 30,000-foot view.
So I think the clearest signal is a 10-year bond. The 10-year bond is now under 4%, and that's signaling a slowdown or a concern of slowdown economically. And I think that is being escalated with the longer this shutdown goes, because the longer the shutdown goes, there'll be less spending in the economy, maybe cracks in the labor market, and also the uncertainty of not getting all the data that we normally get. But the longer this goes, the probability of two rate cuts increases substantially. And so our viewpoint that we've shared with clients is this is like a coiled spring. So as the data gets a little bit weaker and weaker, they're going to pump extra liquidity in the system because of that concern. And then once the government reopens, we get the China deal done, this economy and market is going to explode to the upside, in our opinion, as we go to the first quarter of next year. So I tell investors right now, this bull market is alive and well. We are going to have some choppiness here between now and Thanksgiving, but just take a step back and buy what you think will be much higher at the end of the first quarter of next year. And that's really how we're positioning ourselves. We think this market is really underestimating the growth potential that we're going to see in the first part of next year. So these bears, as we get the VIX spikes to 20, they try to pound their chest, but they've been wrong all year. And I believe humbly they're going to continue to be wrong over the next 6 to 8 months.
Isn't it kind of weird? I mean, I've been doing it a long time. I know you have too, but it's almost like you need to have those bears in the market so the market can go higher, because if everybody's on the same side of the boat, then things don't really work out like we both like it to. And to your point, there's still so many things. The wind is at our back. I mean, you've got the one big beautiful bill that really has got a lot of things in it that really haven't gotten a lot of traction yet. We're going to get some lower regulations out of that. We're going to get some more favorable accounting out of that, which are two big things for at least the small to medium-sized businesses. And then you throw into the fact that you're right. We're going to get a couple more rate cuts, maybe more, who knows, depending on who's in that chair come May of next year. I mean, it all does look pretty good. And then the last segment, we were just talking about the Atlanta Fed GDP now at 3.9%. We're almost at 4%. So I know that there are some weak spots in the economy. There always are. I mean, nothing fires on all cylinders all the time. But I tell you what, it's hard for me to make a case that next year is going to be a difficult one. What say you?
Yeah, no, I agree. What's amazing is we are front loading all of the bad stuff this year, and the market is still up double digits, and we're still grinding higher. And so when you take a look at going into 2026, the tariffs are going to be behind us. Hopefully China and trade will be behind us. And even with all this, the earnings reports that we've been getting have been fantastic. Over 80% of companies have surprised to the upside throughout all of these challenges and the so-called bad tariffs that were going to clobber the economy. And so when you look into 2026 and you have all of those things behind us, we will have gotten through the worst part of the hurdle. And I think the surprise is going to be to the upside on growth. The biggest challenge we're going to have next year, in my opinion, is we may grow so much that the inflation numbers get too hot. And that will be another challenge that we'll have to deal with in the second half of 2026. But in the meantime, getting out of this rally right now, to me, is way premature. I think we have 15 to 20% more upside in the broad market when I look into 2026.
I agree. And I also like what you had to say about Tesla. Now, full disclosure, I own Tesla for a lot of the reasons that you mentioned it. But, I mean, it really is kind of an AI/tech stock. It's not just a car company anymore, and it doesn't trade like that if you ask me. But you're right. I think that he is the way of the future. He's the best mind when it comes to AI. So it's kind of one of those things you kind of have to have in your portfolio, right?
This has been, a big part of the rally is an AI-driven rally. And the reason why I think Tesla's the most important earnings report this week is because what Elon's going to say about robotics and self-driving cars and any new initiatives that they end up taking is going to really move that stock. And when you look at that stock, a majority of its moves in bull markets are in the second half of the year, with November being the strongest month historically for that stock. So when I look at the last 4 quarters of earnings reports, post-earnings, the average move has been about 9%. So it's going to move big one way or another, and it's going to really come down to what Elon says in regards to his vision in AI, which is going to be much more important than anything that have to do with car sales.
Yeah, and I love what you said about robotics. I mean, we've had another analyst on the show probably a couple, 3 weeks ago talking about, boy, that's going to be a huge, huge market for Elon, and it's and a lot of things are moving that way. So I'm incredibly excited about it. We've also got Netflix, I think, reports after the close today, right?
Yeah, Netflix reports. We'll have to look at some.
There?
We want to look at subscriber growth, also what type of new content they have. I'll tell you another earnings report that we're going to keep a close eye on, which I think is next week, is Apple, because of the China dynamic. They get a lot of business from China, so we'll get an idea in regards to how much of a headwind that's actually been. If they surprise to the upside, all bets are off in regards to this bull market, because I think that will say a lot in regards to the perception of how challenging this whole China trade deal has really been.
I mean, all we got to do between you and I, Eddie, is we need to have more and more articles written about stretched valuations and concentrations and all the negative Nellies out there that will help keep things on the right track going higher. I appreciate you coming on. Thank you very much, Eddie. Eddie Ghabour coming to us from Key Advisors.